In the stock market, even the trade that never happens can become evidence. A huge order appears. Other traders react. The price moves. Then the order vanishes. To most investors, it looks like noise. But to market surveillance teams, it can look like a fingerprint. On a normal afternoon, prices flicker across screens. Orders appear and disappear. A stock moves up by a few cents, then down again. Thousands of trades happen every second, too fast for any human being to fully watch in real time. But inside the market, nothing completely disappears. Every order leaves a trace. Every bid, cancellation, burst of buying, and strange price move becomes part of a permanent digital record. And when something does not make sense, the market has systems designed to notice. Market manipulation usually does not look like a dramatic crime in the moment. Sometimes it looks like a pattern hiding inside millions of normal transactions. A stock rises with no public news. A trader places a huge order, then cancels it before it can execute. A small account suddenly makes a perfectly timed bet right before a merger is announced. A thinly traded company explodes online, then collapses after early buyers quietly sell. One strange trade may not prove anything, but the market is not looking at one trade. It is looking at the trail. That trail is where the investigation begins. The first question surveillance systems ask is simple. Does this movement make sense? If a company releases strong earnings and the stock rises, that may be normal. If an entire sector moves because of economic news, that may be normal too. But if a stock jumps before any announcement, or if the same trader keeps showing up before major news, or if large orders keep appearing and vanishing at just the right moment, the system starts paying attention. Modern exchanges, brokerages, and regulators watch the market in layers. Software scans for unusual activity. Analysts review the context. Investigators look for intent. They want to know who acted first, who benefited, whether there was real news, whether the orders were genuine, and whether the same behavior happened before. The market may look chaotic, but to surveillance teams, it is a map of behavior. Case 1, the order that vanished. One of the clearest examples came after the 2010 flash crash. On May 6, 2010, the US stock market suddenly plunged and then recovered within minutes. For a short period, it looked like the market was breaking. Prices moved so violently that billions of dollars in value seemed to disappear and then reappear almost instantly. Years later, authorities focused on a British trader named Navinder Sarao, who was accused of using spoofing and layering in the E-mini S&P 500 futures market. The strange part was that some of the most important orders were never meant to be filled. Spoofing means placing orders that are not really meant to trade, but are meant to create a false picture of supply or demand. Layering is similar. Large orders are stacked at different price levels, making it look like heavy pressure is building on one side of the market. A wall of fake orders appears. Other traders and algorithms see that pressure and react. Prices shift. Liquidity changes. Then the fake orders vanish. Sarao later pleaded guilty to wire fraud and spoofing. What made the case important was not just the size of the market move. It showed that manipulation does not always come from the trade that happens. Sometimes the false signal is the order that never happens. That is why exchanges do not only watch completed trades, they also watch the order book. The bids, offers, changes, cancellations, and timing behind the trades. A surveillance system can ask, who placed this order? How large was it compared with normal activity? Was it cancelled unusually fast? Did the same trader do this repeatedly? Did the price move after the order appeared? Did the trader profit somewhere else after creating the pressure? To a normal investor, the price moved. To investigators, the market just left fingerprints. The machine finds the pattern, but human investigators still have to decide what the pattern means. They are not only asking what traded, they are asking what the trader seemed to be trying to make other people believe. Was there real demand or just the appearance of demand? Was the order placed because someone actually wanted to buy or sell, or was it placed to influence everyone else watching the market? In fast-moving markets, even a false signal that lasts only seconds can matter. Algorithms can respond instantly. Other traders can pull back. Prices can shift. Liquidity can disappear, and if one trader repeatedly profits after creating that false signal, the explanation becomes harder to believe. Case 2. The trader who was always early. Another kind of suspicious trading is harder to spot because it can look like ordinary good timing. Insider trading happens when someone trades based on important non-public information like a merger, earnings surprise, government decision, drug trial result, or major corporate event. The trade itself may look normal. Someone buys stock. Someone buys options. Someone sells before bad news. But the timing can be suspicious. Imagine a small account that almost never trades suddenly buying call options 2 days before a company announces it is being acquired. The price jumps and the account makes a huge profit. That does not automatically prove insider trading, but it raises questions. Has this person traded like this before? Are they connected to someone at the company? Do they know a banker, lawyer, consultant, executive, board member, or employee with access to the deal? Did they trade before other announcements too? This is where market surveillance becomes a giant pattern-matching system. Regulators can compare trading records, public announcements, messages, relationships, account history, and timing. The system is not just asking, did this person make money? It is asking, how often are they in the right place before the news breaks? There's another clue investigators look for: behavior that does not fit the person's history. A professional trader buying a stock may not stand out, but someone who rarely trades suddenly making a large, risky bet before market-moving news looks very different. Options trading can be especially suspicious because it can create a large profit from a relatively small move in the stock. From the outside, it may look like luck. But investigators ask how many times luck can repeat before it becomes a pattern. Case 3. The stock that exploded online. Stock exchanges also watch for manipulation in thinly traded stocks, where prices can be moved more easily. In a huge company with millions of shares changing hands, one trader may not move the price much. But in a small stock with low volume, a few coordinated trades can create the illusion of momentum. Surveillance teams look for sudden volume spikes, unusual price jumps, repeated trading between connected accounts, and patterns where the same accounts appear again and again. This is the basic idea behind many pump-and-dump schemes. First, attention is created, then the price rises. Then the people who were there early sell while new investors are still buying. Today, the promotion may happen through social media, private chat groups, fake investment clubs, or messaging apps. The chart spikes, the promotion spreads, and the early accounts start selling. The technology changes, but the pattern is familiar. Create hype, make the stock look like it is taking off, then exit before everyone else realizes what happened. The hidden system has to watch not only the trades, but also the behavior around the trades. Was there a sudden wave of promotion? Did buying begin before the public hype started? Did the same people who helped create the excitement begin selling once the price rose? But detection is not as simple as flagging every stock that rises quickly. Markets move for real reasons too. A company may release good news. A sector may rally. A rumor may spread. A legitimate investor may buy aggressively because they believe the stock is undervalued. So surveillance systems have to separate strange from illegal. That is why alerts are only the beginning. The first layer is automated. Software looks for unusual activity. The second layer is human. Analysts review the context. The third layer is investigative. Regulators may request records from brokerages, examine communications, trace relationships, and build a timeline. They want to know not just what happened, but why it happened. Was the trader trying to deceive the market? Did they know confidential information? Were the orders real or just bait? Did multiple accounts work together? The most interesting part is that market manipulation often leaves behind a cleaner trail than people expect. A phone call can be denied, a conversation can be hidden, a public post can be deleted, but trading data is precise. It records time, size, price, account, routing, order changes, cancellations, and executions. In modern markets, investigators can reconstruct a timeline down to fractions of a second. They can see the fake wall of orders appear. They can see the price react. They can see the cancellation. They can see the profit. They can see whether the same pattern happened yesterday, last week, or across multiple stocks. This is why the hidden system behind the stock market is not just about speed, it is about memory. The market remembers what every participant did. It remembers the order that vanished. It remembers the account that traded before the announcement. It remembers the promotion that started before the price spiked. Most investors see the market as a stream of prices. Surveillance teams see it as a map of behavior. They are watching who acted first, who benefited, who cancelled, who promoted, who repeated the pattern, and who was connected to whom. Markets are naturally unpredictable. Prices move because buyers and sellers disagree. News changes expectations. Fear and greed push money around. But surveillance teams are trying to find the moments when the market is no longer just unpredictable, but manipulated. To ordinary investors, the stock market may look like a chaotic stream of numbers. But behind that stream is a surveillance network constantly asking one question: does this movement make sense? Most of the time, the answer is yes, but sometimes the pattern is too strange. A trader is always early. An order is always cancelled. A stock is being pushed by accounts that seem connected. A tiny company suddenly becomes the center of online hype, and the same people who helped create the excitement are quietly selling into it. That is when the market's hidden alarms start going off. And that is how manipulation is often detected, not from one dramatic moment, but from a trail of tiny decisions that, when placed together, tell a much bigger story. This is Systems Atlas. Subscribe to explore more of the world's hidden systems.